Being someone who's both a dividend growth investor and an income investor, I'm always on the hunt for good high-yielding investments that can provide me with solid income and growth potential. And over the last few years, we've seen a handful of these new ETFs being created that are geared towards people looking for higher income. New funds like JEPI, SVOL, and also the various Global X covered call ETF variations like QILG and QILE were launched to meet the demands of investors who want high amounts of monthly dividend income. Today we're going to take a look at a newer ETF that was launched less than a year ago, which is SPYI, and it touts some really impressive features on its website. The Neos S&P 500 High Income ETF is a fund that seeks high monthly income in a tax-efficient manner with the potential for upside appreciation in rising markets. The fund invests directly and through derivatives in stocks of companies operating across diversified sectors and uses derivatives such as options to create its portfolio. The fund seeks to generate high amounts of monthly income from the premiums earned from SPY call options as well as the dividends received from the fund's equity holdings. It's an actively managed ETF by Neos Funds and was launched on August 30th, 2022. Right now, SPY touts a massive 12.29% monthly dividend distribution. To put that into perspective, a $10,000 investment in SPYI at its current share price and dividend distribution would mean that this ETF would pay you almost $100 every month in dividends. That's a huge amount of passive income every month from honestly not that big of an investment. If you invested $10,000 in Johnson & Johnson stock right now, you'd only receive about $24.13 a month if you divided the quarterly dividend by 3. So for people looking for high amounts of monthly income, SPYI definitely looks like an attractive investment. But let's take a deeper look into this fund and see how it works and see if it's worthy of consideration for income investors. On this fund's website, SPYI touts 3 unique features that are worth diving into, which are high monthly income, low correlation, and tax efficiency. So we'll cover all 3 of these features, starting with how it generates high monthly income. SPYI seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and by implementing a data-driven call option strategy. The income that SPYI pays comes from 2 different sources, which are from the dividends that all the companies in the S&P 500 index pay, as well as the premiums generated from the fund's call option strategy on the S&P 500 index. A covered call strategy is when the fund buys the stocks in the S&P 500 index and writes or sells corresponding call options on the same index. And then the premiums received from selling the call options provides the income that we as investors receive. As the ticker suggests, SPYI basically invests and executes its option strategy on SPY, which is the SPDR S&P 500 ETF. If we compare its holdings side by side to each other, we can see that they're pretty similar. We can see Microsoft, Apple, Nvidia, and Amazon are some of their largest holdings. In a way, this fund has some similarities to XYLD, which is the Global X covered call ETF that uses covered calls on the S&P 500. But unlike XYLD, SPYI is different in a few different ways. One of the most important ways SPYI is different from other covered call funds is that this fund sells something called call spreads. This means that unlike other covered call funds, this ETF won't totally limit its upside potential and will see more share price growth during periods when the S&P 500 is rising. I'll give an example to show you how this works. Let's say you have a stock that's currently trading for $20 per share. Using a traditional covered call strategy, you might sell a covered call on it for $25 per share. This limits the amount of upside potential that you can experience from this, which is $5. A call spread, on the other hand, works differently. Using the exact same example, instead of writing a covered call on this $20 stock for $25, you instead write a call spread of $25 to $30. Selling a call spread means that when the market is rising, you can potentially collect more from using options as opposed to a regular covered call strategy. This should result in the share price of this ETF rising more when we're experiencing a bull market. So for this year, SPYI is up over 8%, which is a lot better than XYLD. When factoring in the dividends though, both have resulted in pretty similar returns. Since this fund's inception, its share price is only up 2%, which does make sense considering it launched last September when the whole market was still falling. If we look at their dividend distributions for this ETF, we can see that it pays monthly dividends, which is great, and their dividend up to this point has remained pretty stable. In fact, all of their dividends have been between 46 cents per share and 49 cents per share. But there's a third feature that sets SPYI apart from other covered call funds. The third point on this fund's website is that this fund's index options are classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. To get a good idea of what this means, I went to this fund's prospectus and this is what it said. Quote, "The fund seeks tax-efficient returns by utilizing index options that receive favorable tax treatment under the Internal Revenue Code rules because they qualify as Section 1256 contracts. Under these rules, each Section 1256 contract held at the fund at year-end is treated as if it were sold at fair market value on the last business day of the tax year. If the Section 1256 contracts produce capital gains or losses on the Section 1256 contracts open at the end of the year or terminated during the year and treated as 60% long-term and 40% short-term regardless of how long the contracts were held. In addition, the fund may seek to take advantage of tax loss harvesting opportunities by taking investment losses from certain equity and/or options positions to offset realized taxable gains of equities and/or options. What this means is the dividends that you receive from SPYI can be taxed as a mixture of both short-term and long-term capital gains. This is pretty different from other covered call funds who classify their dividend distributions as being treated as ordinary income. This means that SPYI might be a more attractive investment to people who are looking for a high-yielding position in a non-retirement account. The biggest downside to pursuing high-yielding investing is how dividends are taxed, considering that all the higher-yielding investments like REITs, business development companies, and closed-end funds usually tax their dividends as ordinary income. With this ETF though, these 1256 contracts do leave you with the possibility of paying a lot less in taxes when dividends are issued each month. I haven't come across another ETF that taxes their dividends this way, and maybe others do exist, I'm just not aware of them. But this method of taxation can save you a lot of money if you were to build up a very large position in this ETF. But while everything is looking good so far, let's cover a couple of the issues. For starters, SPYI is an actively managed fund, which entails a couple things. First, actively managed funds almost always come with higher expense ratios, which is true for SPYI. You can see on this fund's website it has an expense ratio of 0.68%, which is far higher than most ETFs and even most covered call ETFs. The Global X ETFs usually charge a 0.6% expense ratio, and JEPI charges a 0.35% expense ratio. So at 0.68, this is a really expensive fund, but as I always like to say, if a fund does charge more but can offer me either exceptionally great returns or a feature that I really want, then I am the kind of person that's willing to pay more. It's possible the reason this fund charges such a higher expense ratio is because they know they're saving their investors money on taxes. It's just a theory, but I wouldn't be surprised if that's what's going on here. But another key to actively managed funds is that you have to have faith in the people managing it. While going through the prospectus for this ETF, I saw that two of the managers for SPYI are Troy Cates and Garrett Paolia. It was brought to my attention that these two guys are actually the exact same fund managers for another covered call ETF that exists, which is the nationwide NASDAQ 100 Income ETF, ticker NUSI. If you scroll down to the bottom of this fund's page on Nationwide's website, you can see them listed as being fund managers for this fund too. If you've been watching my channel and following along, you'll know that I used to be a shareholder of NUSI. Between late 2021 and late 2022, this fund lost over 35% of its value. Fortunately, NUSI has done a lot better this year with a year-to-date return of over 17%. Another concern I have for this fund is its age. SPYI is still such a new fund that we haven't seen it perform under more stock market conditions. But up to this point, the results we've seen from this ETF have shown that it does have potential in my opinion. If we look at the total return for SPYI and XYLD with dividends being reinvested, we can see that SPYI just recently pulled out further ahead. This fund has seen a year-to-date return of 12.56% compared to Global X's fund at 8.89%. We are only halfway through the end of this year, but so far things are looking pretty good for this ETF. So with all things considered, is SPYI the best monthly dividend ETF out there? While I'm personally most concerned about the management team, it is true that SPYI is a fund that follows a different strategy. And as long as the managers stick with this strategy, hopefully we won't see another huge price decline like what happened to NUSI. I've been combing through a lot of information and looking at its financials, and I've been getting more excited about this fund's future. I'm not suggesting it's worthy of becoming your largest holding, but what I am saying is as of right now, I think this fund does have the potential to eventually become a better S&P 500 covered call fund than XYLD, but we'll still have to wait and see. I am a shareholder of XYLD, and it is possible that I may eventually switch into SPYI instead if it continues to perform well. If you're a fan of higher yielding monthly dividend paying securities, then SPYI has been a pretty decent choice up to this point, and I'm looking forward to seeing how it performs in the months and the year ahead. But with that being said, that's going to wrap up our look today at the Neos S&P 500 High Income ETF. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.